Welcome to the Deep Dive. We sift through earnings calls, articles, you name it, and boil it down to what really matters. Today we're digging into Helen of Troy Limited, specifically their first quarter fiscal 2026 earnings call. And let's just say this past quarter was pretty rough for them.
Yeah, rough is probably putting it mildly. They definitely faced some major headwinds.
Right, mainly driven by all the tariff changes and, well, shifts in how consumers are spending.
Exactly. So we're going to unpack the financials, look at what management's doing about it, and try to figure out, what this means for the company going forward.
It's definitely a complex situation. External factors hitting hard, forcing them to reevaluate things.
Our goal here isn't just the numbers, but the why behind them, and crucially, how they plan to navigate all this.
Okay, let's kick off with a quick snapshot of the results. As we said, a tough quarter. Results definitely came in below expectations.
Yeah, consolidated net sales, they dropped by 10.8%.
And organic net sales, even steeper, down 17.3%.
Oof. And gross profit margin took a hit too, down 160 basis points to 47.1%.
Then there's adjusted diluted EPS. That came in at just $0.41, a big drop from 99 a year before. Pretty stark figures.
They really are. It shows you the scale of the challenges. But there was one bright spot worth mentioning.
Oh, what was that?
Free cash flow. It was actually quite strong. They generated $45 million.
Wow, compared to $16 million last year.
Exactly. So even with the revenue and profit pressures, they're still managing to convert sales into cash pretty effectively. That gives them some breathing room, some flexibility.
That's a really important point, especially right now. Okay, so why were the numbers so rough? Let's get into those headwinds. Tariffs seem like a big one.
Huge. They attributed about 8 percentage points of that consolidated revenue drop just to tariff disruption.
8 points. Wow. So that includes things like cancellations of direct import orders from China?
Yes, because of the higher tariffs and just general uncertainty around trade policy.
Yeah, makes sense.
And it wasn't just cancellations. There was also a big pull forward effect.
So retailers ordered more in the previous quarter, Q4 fiscal 25, to get ahead of tariffs.
Precisely. Which meant they were sitting on higher inventory levels, and then, boom, Q1 replenishment orders were way down.
And they expect that softness to continue into Q2.
Yeah, that's what they indicated. Plus, the China market itself got softer. There's a shift away from cross-border e-commerce towards more localized distribution.
And more competition from local sellers getting subsidies.
You got it. So it's like a perfect storm on the tariff front. Multifaceted, really.
Okay, so tariffs were massive. What else? You mentioned consumer behavior.
Yeah, very clear evidence that consumers are trading down, opting for cheaper alternatives.
We're seeing that everywhere, aren't we?
We are. And for Helen of Troy, it meant average prices in their U.S. business compressed by about 3 to 4%. That hits both the top line and the bottom line.
So even if they sell the same number of units, they're making less money on them.
Exactly. It really puts pressure on brand pricing power when inflation is up, but consumers are looking for value.
Gotcha. What about retailers?
They were adjusting their inventory too, changing their target weeks of supply because consumer demand patterns were shifting.
Which slows down replenishment orders, right?
Right. Especially, they noted, in Asia Pacific. Apparently, they had a milder illness season, so demand for things like thermometers was lower than usual.
Okay, so tariffs, consumer trade down, retailer adjustments, and the financial impacts went beyond just lower sales.
Oh, yeah. Gross margin pressure wasn't just the trade down. It was also higher retail trade expenses, some unfavorable comparisons on inventory obsolescence.
Inventory obsolescence, like older stock.
Yeah, maybe having to write down more older stock compared to last year, and also a less favorable mix of brands sold within their home and outdoor segment.
Okay, and what about overhead, SG&A?
That ratio went up significantly. A bunch of factors there. Some planned investment in growth initiatives, costs related to the CEO transition.
Right, they have an interim CEO and CFO right now.
Higher outbound freight costs, expenses from the Olive & June acquisition they made.
Integration costs.
Yeah. And just the basic math of lower sales creating unfavorable operating leverage, costs spread over fewer revenue dollars.
They did mention Q1 is typically their lowest revenue quarter, so that ratio often looks higher anyway.
They did make that point, yeah. But the really big number was the GAAP operating loss, $407 million.
Whoa. How much of that was cash?
Well, that's the thing. The vast majority, $414 million, was actually non-cash impairment charges.
Impairment. Like writing down the value of assets.
Exactly, like brand goodwill. It basically reflects the sustained drop in their stock price. It's an accounting charge, not cash out the door, but it's still a significant hit on the books.
Wow. Okay, so quite the quarter. Lots of challenges hitting them at once. But it sounds like management isn't just sitting back.
Not at all. This is where it gets interesting. They outlined a pretty clear strategic response. The interim CEO, Brian Grass, and interim CFO, Tracy Scheinman, they were pretty candid.
How so?
They acknowledged the company had become, and I quote, too matrixed, too slow, and at times disconnected.
That is candid. You don't always hear that level of self-assessment.
No, you don't. And it suggests they're serious about making changes. They laid out 5 key priorities to get back to profitable growth.
Okay, let's hear them.
Priority 1, restore confidence. Internally with employees and externally with customers, retailers, investors, focus on being adaptable.
Makes sense. Rebuild trust. What's 2?
Improve go-to-market effectiveness and simplify operations. Basically, cut costs, get leaner, more agile. They mentioned Project Pegasus, their internal efficiency initiative.
Okay, streamline things. Number 3.
Refocus on innovation. Product-driven growth. They mentioned the dry bar all-inclusive styler as an example. And optimize marketing spend, focus on higher ROI channels.
So better products, smarter marketing. Got it. 4.
Back to fundamentals. Do fewer things, but do them better. Leverage the unique strength of each individual brand. They admitted they'd maybe homogenize things too much.
Interesting. Let the brands be brands again. And the last one, 5.
Reinvigorate the culture. Build resilience, foster an owner's mindset. They really emphasize culture as key to the turnaround.
Sounds pretty comprehensive, like a real overhaul. What are the tariff problems specifically? Any progress there?
Yes, significant progress, actually. They're actively building out sourcing in Southeast Asia, dual sourcing production for key items.
So not having all their eggs in the China basket.
Exactly, and even making capital investments to replicate some China production elsewhere. Plus, they're planning strategic price increases.
Price increases in this environment of trade down. That's bold.
It is, but seemingly necessary to offset the tariffs. They're talking an average of 7-10% across the portfolio. Some items might be 0%, some up to 15%, set to take effect late summer.
And they think this will significantly reduce the tariff hit.
Yeah, they now expect the net impact on operating income to be less than $15 million, which is way down from initial estimates when tariffs look like they could be much higher. That's based on a 30% tariff rate assumption now.
That's a massive improvement in mitigation. How are they achieving that? Just the price hikes?
It's a combination. The pricing helps, but the supply chain diversification is huge. They project reducing their exposure to China tariffs on U.S. imports down to about 25% of cost of goods sold by the end of this fiscal year, FY26.
25%. Down from what? Must have been much higher.
Oh, undoubtedly. And they plan to get it down further to around 15% by the end of fiscal 2027.
Wow. That's a serious shift.
In parallel to that, they expect over 40% of their U.S.-bound goods that are still sourced from China to be dual-sourced by year-end FY26, growing to over 60% by end of FY27.
So building in that flexibility and redundancy, smart.
Definitely a big strategic move for the long term.
Okay, so despite all the headline gloom in Q1, were there any underlying positives? Things easy to miss.
Yeah, actually there were, which is important. For instance, in the U.S., point-of-sale unit growth was actually positive for 8 of their 11 key brands.
8 out of 11 saw unit growth. So people are still buying the products, just maybe cheaper versions.
That seems to be the story. Unit demand is there. And point-of-sale dollar growth in the U.S. mass channel was up 4.4%.
Okay, interesting. Any specific categories doing well?
Yep. They called out prestige hair liquids, air purifiers, and thermometry as showing strong category growth. Their ETC business grew 9%.
And what about the big brands? How did Osprey do?
Osprey held up well. Revenue up 3.7%, point of sale up 3.8%. They're expanding beyond just the technical packs, too, and still hold #1 market share.
Nice. Others?
Curl Smith revenue grew 17%, driven by new liquids and that Phrygian Curl Reviving Wand.
17% is strong.
Very strong. Olive & June, the acquisition, continues to exceed expectations. Good growth, profitability, even got recognized by Fast Company.
Yeah.
And they just launched on Amazon.
Okay, good momentum there. Hydro Flask.
Showed continued strength. Apparently, consumers are shifting back to more traditional bottles, which helps them. The new Micro Hydro bottle is doing well. And international business grew in Asia Pacific and Canada.
Good to see some international strength.
Yeah. Revlon gained share in the sub-$100 category. The dry bar styler had a good soft launch, now rolling out wider. And they secured new distribution for products like the Pure Slim Pitcher at Walmart and Vicks Vapo Steam Lavender for the upcoming cough cold season.
So pockets of real strength and innovation are still there?
Definitely. It shows the underlying brands still have pull.
Okay, let's shift to the investor view. What's the outlook? They're only guiding for Q2, right?
Correct. Just Q2 for now. Citing all that uncertainty, we talked about tariffs, inflation, consumer spending, especially in discretionary stuff.
And what does Q2 guidance look like?
Net sales projected between $408 million and $432 million. That implies another decline, 9% to 14% year over year.
So still negative territory. And EPS?
Adjusted diluted EPS expected between 45 cents and 60 cents. So slightly better than Q1's or 41 cents, but still significantly down year over year.
And they expect those headwinds, tariff disruption, soft demand, cautious retailers to persist through Q2.
Yeah, that's the message. They also flagged that inventory levels will likely rise by the end of Q2, maybe $510 to $520 million. That's partly seasonal buildup, but also reflects capitalized tariff costs getting absorbed into inventory value.
So Q2 still looks pretty challenging, but management sounds optimistic about the second half of the year.
Surprisingly optimistic, you might say. They're anticipating a pretty pronounced improvement later in the fiscal year.
Okay, what's driving that optimism? What are they banking on?
It's a combination of factors they expect to kick in. First, the full impact of those price increases they're implementing.
Right, the 7-10% average hike.
Second, they expect retail inventory levels and that direct import ordering pattern to stabilize. Retailers will have adjusted.
Okay, less volatility there.
Third, they're assuming a, quote, normal cough, cold, and flu season, which, compared to recent milder seasons, would actually be an improvement for sales of those related products.
Ah, interesting. A return to normal would actually be a tailwind for them.
Seems like it. Fourth, they'll start benefiting from those pre-secured distribution gains like the blood pressure monitors at Walmart, the international expansion for Hydro Flask and Osprey we mentioned.
Okay, new shelf space starting to pay off.
Plus, improved efficiency from their distribution centers, continued growth from Olive in June, and lower interest expense because they keep paying down debt with that free cash flow.
So you add all that up.
And you can see why they expect a much stronger second half. They even went as far as suggesting the current full-year consensus EPS estimate, which is around $5.
$5, after starting with $1.41 in Q1 and guiding 45 cents to zero volatilizer and 60 cents for Q2.
Exactly. They said that $5 full-year number is not unreasonable, which implies a massive sequential jump in earnings in the second half, almost like a hockey stick recovery on the chart.
That is ambitious. A lot has to go right.
It certainly does. Meanwhile, the board is actively searching for a permanent CEO, looking for someone with deep brand building chops. The interim CEO is focused on product innovation and simplifying things for faster execution.
Okay, one more point on current dynamics. Sell-through versus sell-in. The point of sale data.
Right. That unit growth in most brands is a positive sign. Consumers are still choosing the products.
But the dollar POS decline shows that trade-down effect clearly. People are buying, but spending less per item.
Precisely. And on retail inventory levels, management described them as pretty well balanced overall. A few pockets of over-inventory, but not widespread disaster. Though they still expect some retailer adjustments in Q2.
So the inventory situation isn't maybe as bad as feared, which could help replenishment later.
That seems to be the implication. If demand stabilizes and prices stick, orders could pick up.
All right. Before we wrap this deep dive, let's shift gears slightly. Time for our not financial advice segment. Let's brainstorm an outrageous but plausible trade idea based purely on this call. Imagine we're pitching this.
Okay, I like this game. So the pitch to the hypothetical investment committee. All right, team, listen up. Helen of Troy's Q1 was, frankly, abysmal. Got hammered by tariffs, write-downs. Market hates it right now. Focus is totally on the rearview mirror.
But we continue. Management just laid out a super detailed roadmap for a major second half turnaround. Tariff mitigation is key. Those price hikes, the supply chain diversification, plus Project Pegasus efficiencies finally kicking in.
So the play. We go long. With conviction. We're betting on a big re-rating later this fiscal year. The outrageous part. We have to believe that Q1's $1.41 EPS and Q2's weak guidance, maybe SOFIS and 50 cents, is the absolute bottom.
And that they can actually ramp earnings dramatically in H2 to get somewhere near that $5 full-year consensus. That's a steep climb.
Exactly. The plausible part rests on execution. Can they make those 7–10% price hikes stick? Will retailer inventory really stabilize? Will Project Pegasus deliver savings? If yes, the operating leverage could be huge.
So it's not just a hope for recovery play. It's a bet on this specific management team navigating this mess and delivering that hockey stick earnings profile. We get in before the market fully buys into the H2 pivot.
Outrageous, yes. Plausible if everything lines up? Maybe.
Yeah.
Definitely not advice.
Definitely not. Okay, let's bring it back and recap. Helen of Troy faced a seriously tough Q1. Big hits from tariffs, consumers trading down, costs going up.
But management isn't hiding. They've laid out a clear 5-point plan. Simplify, innovate, execute better, fix the supply chain, raise prices strategically.
They seem genuinely confident in a much stronger second half for both sales and profits, aiming to get back to profitable growth and deliver shareholder value long term.
It's a turnaround story in the making, but the next couple of quarters will be crucial for proving they can execute that plan.
Absolutely. And remember, everyone, this deep dive is purely for informational purposes. It is absolutely not financial advice. As you digest all this, maybe ask yourself, if you were watching Helen of Troy, what specific signs or data points would you need to see in Q2 or Q3 to really believe in that optimistic second half forecast?